an investor in Ontario and an investor in Edmonton buy the same size apartment building this year. One cash flows from day one. One is feeding it cash every single month just to keep the lights on. The only difference is the province. That is not a theory. That is what the numbers actually show right now. And if you're still treating Canadian real estate as one market, you are making a decision based on an average that does not exist. In this video, I want to show you exactly why Alberta still works while Ontario doesn't. In the next few minutes, I'm going to break down the rent to price difference between these two markets, what Alberta's population growth actually means for rental demand, and why CMHC-eligible multifamily in Edmonton is producing cash flow that Ontario investors cannot access right now, regardless of how long they have been in the game. By the end, you will have a clear picture of why the province you invest in may matter more than the deal itself. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined CMHC-eligible multifamily investing, especially in Alberta, markets like Edmonton and Calgary. Stay with me until the end, because I'm going to walk through a real Edmonton project we are currently looking at, and I'm going to show you what the monthly cash flow looks like compared to a comparable Ontario asset. The gap is not subtle. Let's start with how investors are getting misled. Every week there is a new headline about the Canadian housing market. Prices are too high. Affordability is broken. The market is cooling, the market is heating up. Interest rates are the problem. If you are reading those headlines and making investment decisions based on them, here is the issue. When the media says Canadian real estate, they almost always mean Toronto and Vancouver. Those two cities are so dominant in the data that they pull the national average in their direction and make everything else look like it follows the same pattern. This is where investors confuse access with safety. They assume that because they understand Ontario is where they should be putting capital. But right now, the numbers in Ontario are not working in your favor, and the numbers in Alberta are. Here is what it actually feels like to own a multifamily property in Ontario right now. You bought it, it went up in value, and you still cannot scale because the cash flow is not there to support the next mortgage. Cap rates in Ontario have compressed to the point where, on a stabilized multifamily asset, you might be looking at a 3.5% to 4% cap rate. At today's financing costs, that math does not produce cash flow. It produces a break-even at best and a monthly shortfall at worst. That is when paper returns become real pressure. You are sitting on equity that looks good on a net worth statement, but every month that property is either flat or it is costing you money. And because it is not generating surplus income, you cannot qualify for the next deal. You are stuck. The structure is the problem. In Ontario, the purchase price has disconnected so far from what the rents can support that no amount of creative financing fixes the underlying math. Now contrast that with Alberta. Alberta added over 200,000 people in a single year, the fastest provincial population growth in Canada. These are not temporary residents. These are people relocating from Ontario and BC, specifically because Alberta is more affordable and the job market is strong. They need housing and they are renting. Here is where the rent-to-price ratio becomes the most important number in the conversation. In Edmonton, you can acquire a CMHC-eligible multifamily building where a two-bedroom unit rents for roughly $1,400 to $1,600 per month, and the purchase price per door is a fraction of what you would pay in Toronto for the same unit. When you run the debt service against those rents using CMHC-ML, I select financing. With a 50-year amortization and a lower insured rate, the property cash flows, not on paper. Actually, in Ontario, that same building would cost 2 to 3 times more per door, the rents would not be proportionally higher, and the financing advantage would not close the gap. You would be feeding it cash from month one. Quick question for you. If you own property in Ontario, right now, are you actually cash flowing, or are you holding and hoping the appreciation covers the shortfall? Drop it in the comments. I'm genuinely curious how many people watching this are in that position. It also helps me understand what to break down in future videos. Let me make this concrete. We are currently looking at a multi-family project in Edmonton. Because the asset is CMHC eligible, we can structure it under CMHC-ML. I select financing. That means a 50-year amortization, a lower insured interest rate, and a higher loan-to-value than conventional financing would allow. When you combine Edmonton's current rent levels, the purchase price per door, and that financing structure, the monthly cash flow on this project is positive from day one, not marginal. Meaningfully positive. Now run the same exercise on a comparable Ontario asset. The purchase price per door is significantly higher. The cap rate is lower. The CMHC financing structure is the same. But the underlying economics of the market cannot support the same outcome. The debt is too heavy relative to what the rents produce. This is not about Alberta being perfect. It is about the math working in Alberta right now, in a way that it does not work in Ontario. And for investors who are serious about scaling, that difference is not a minor consideration. It is the entire decision. Here is the real point. Most investors who are stuck are not stuck because they lack ambition or capital. They are stuck because they are trying to scale inside a market that structurally cannot support the next step. Ontario gave a lot of investors their first win. Appreciation did the work and it felt like a system. But appreciation is not a system. Cash flow is a system. And right now, the cash flow is in Alberta. The shift is not complicated. It is reallocating capital from a market where the math is working against you into a market where the math, combined with the right financing structure, is working for you. That is what CMHC-eligible multifamily in Alberta actually represents. Not a trend, a structural advantage. If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week I break down how serious investors evaluate CMHC-eligible opportunities, financing structures, and real portfolio growth strategies before capital gets committed. And if you have a question you want me to cover next, drop it in the comments. I read through them. If you want to see the actual numbers on current Alberta multifamily opportunities, click the link below to download the deals we are looking at right now. Thanks for watching, and I'll see you in the next video.